One of the questions from our Patreon sponsors was about small caps versus large caps. Which is best and what kind of environments would you buy one over the other? So let's find out about that in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. Let's start out with the UK market, looking at small caps versus large caps. A small cap is just a small company. For example, Topps Tiles has a total of about 200 million shares. At the time of this recording, each of those shares was worth 63 pence. And 200 million times 63p gives you £124 million. That's the market cap of Topps Tiles, which is the total value of all its shares. And that is a tiny company. When we compare it with a large cap company like Royal Dutch Shell, that has almost 1 billion shares in issue, each of which is worth £25. Multiply the two together and the market cap is over 200 billion. So you can see the massive disparity between the small companies and the large companies which trade on the London Stock Exchange. There's a roughly 2,000-fold difference between the tiny companies and the huge companies. And there's also a fundamental difference between the way the two types of stock trade. In this diagram, companies are ranked from largest at the top to smallest at the bottom by market capitalization. The FTSE 100 contains the largest 100 companies. Then the next 250 largest go into the FTSE 250, and we call those mid-cap companies. And all of the rest, from 351 down to about 620, go into the FTSE small cap. There's also a FTSE 350, which is the 100 and 250 combined, and the FTSE All Share, which contains everything. Now, the fundamental concept that you have to understand when thinking about small caps is called liquidity. Liquidity tells you how easy, fast, and cheap it is to buy and sell a company's stocks. And if you understand this graph, you'll pretty much understand what liquidity is. This contains all of the FTSE All-Share stocks which trade on the London Stock Exchange. Small caps are on the left, and large caps are on the right. And on the y-axis, we have high liquidity at the bottom and low liquidity at the top. And for liquidity, we've used the difference between the buying price and the selling price of the stock. So for the low liquidity stocks, they're more expensive to trade. I've color-coded the FTSE 100 in red, so those are the large caps at the bottom right. And you can see that because they're large cap, they trade millions of pounds worth of shares every day, and they're very high liquidity. Brokers don't have to make such a big markup because they trade a very large volume of shares every day. The FTSE 250, which is mid-caps, is in green. And the FTSE small cap has much lower trading volumes. And that means the brokers have to widen their bid-offer spread, or the difference between the buy and sell price. That makes it much more expensive for investors, and more importantly fund managers, to buy and trade those stocks. Another key difference between small caps and large caps, at least in the UK, is that the FTSE 100 contains many multinational companies. And you can break down revenue by whether it's generated overseas or domestically. And for the FTSE 100, about 2/3 of the revenue is generated overseas. And if we do the same thing for the mid-caps in the FTSE 250, the revenue generated is roughly 50% domestic and 50% overseas. And although it's not shown here, for the FTSE small cap it's also roughly 50-50. So small caps and mid-caps are more domestic than the FTSE 100, but still not completely domestic. There's still 50% of their revenue being generated overseas. The reason why we're interested in small caps is their performance. Over the last quarter century, it's clear that the FTSE 250 has won by a mile compared to small caps and also large caps. Looking at the annualized returns, you can see the FTSE 250 has returned about 7% versus the small caps 4% and the FTSE 100's 3%. And although you often hear that small caps are more risky than large caps, in fact their volatility is fairly low. It's 11% versus about 18% on the FTSE 100. So volatility might not be the best risk measure to look at when you're comparing these small cap and large cap stocks. A key component of long-term return is the dividend you get paid. That's a proportion of the company's profits which is paid to you as a shareholder. And the UK market's particularly generous when it comes to dividends, which means that it makes up a very large component of the long-term return. The FTSE 100 Total Return Index is the upper red line, and the Total Return Index incorporates that dividend. And you can see that boosts the return from the lower to the upper red line. And the FTSE 250 also gets a big boost from dividends. In fact, for the FTSE 100, it more than doubles the return from 3.1% to 7% over the last 9 years. And for the FTSE 250, you get about a 4% boost. Now, one of the problems with small caps is that they don't generate as much dividend. Because if you're trying to grow a company, you plough your profits back into the company to grow organically, rather than paying it out to shareholders. So you rely on capital growth, not dividend payments, to generate your return. And although volatility wasn't a good measure of risk, looking at what happens during a crisis gives you a better feel for why small caps are risky. Small caps here are shown in blue, and they lost about 60% of their value in the credit crisis, versus about 50% for the FTSE 250 and about 40% for the FTSE 100. In the dot-com bubble between 2001 and 2003, the pain was felt more evenly, but you can see small caps still came off worst. And in the latest sell-off, let's call it Red October for 2018, it's actually the FTSE 250 which has sold off most so far. Now those were the indices. You can't actually buy an index directly, you have to buy a fund which tracks the index. So let's take a look at the small cap trackers. Unfortunately, the selection of exchange-traded funds which track the small cap market in the UK is limited to one fund. And this is managed by BlackRock under the iShares brand, and it tracks the MSCI UK Small Cap Index, not the FTSE Small Cap Index. Looking at that fund on Morningstar, we can see why it's so attractive. The long-term projected earnings growth is very high at 10%, and over the long term, prices will track the earnings growth. It's a little bit surprising if you look at the market capitalization breakdown of the fund, because you can see that more than half of them are medium caps, not small caps. It would simply be too expensive to track those small cap indices. The management fee would be very high, so this fund's been forced to shift the market cap into the mid cap range. And if we look at the MSCI UK Small Cap Index, you can see the largest company has a market cap of over 7 billion euros. If we look where that lies on our graph, it goes well beyond the small caps, which are the blue stocks on the left. It eats partially into the mid caps, and it's even encroaching into the large cap region, which is the red stocks, which are in the FTSE 100. Looking at the top 10 constituents of that index, 5 of them are in the large cap FTSE 100 index, 4 are mid caps in the FTSE 250, and 1 of them is in the AIM index. This tree illustrates the correlation between different funds and indices. The fund we're interested in is at the top, and its ticker is CUKS. And what you can see is that its correlation is most tight with the FTSE 250 index, tighter in fact than its correlation with the FTSE Small Cap Index, at almost 95%, whereas its correlation with the Small Cap Index is only 79%. So if you're going to buy this fund, be aware that it's not just small caps. You'll also be buying a very large slice of the FTSE 250. If you want richer pickings with the small caps, you're going to have to go for global small cap funds. 2 of the most popular in the UK are the Vanguard Global Small Cap Index Fund, which has been around for a long time, and the newcomer from BlackRock. Both track the MSCI World Small Cap Index. And you can see that BlackRock has tried to steal the market from Vanguard by having a very slightly lower ongoing charge of 0.35% per year versus Vanguard's 0.38% per year. But notice that this is much more than you'd pay for tracking a much more large and liquid index like the FTSE 100. It's always worth looking at the fund fact sheet because this tells you the risks of owning the fund. The first thing to see is that it doesn't buy all of the stocks in the index. In order to reduce the trading fee, it only buys a subset of the securities that make up the index. It'll avoid the least liquid ones, and that will induce a tracking error. It won't track the index perfectly. In order to generate some revenue, the stocks which are bought by the fund manager will be lent out to other investors. Some of that money will go to the fund manager, BlackRock, and some of it will be used to reduce your fee. Don't try to make short-term plays with this index. Buy it and hold it for the long term, because then you'll get the most out of it. And because it's global small caps, it's US dollar denominated. That means you take an additional currency risk of sterling versus the US dollar. You should also be aware that the name of the index, which is the World Small Cap Index, actually refers to the developed world. In the graph at the bottom, you can see a comparison of the total return with the ACWI Small Cap Index. where AC stands for all country, and that includes emerging market stocks like China. In the bottom right, you can see the country weights of the index, and as with any developed market stock index, it's dominated by the US, which makes up about 60% of the index. Then we get Japan at 12%, and the UK makes up only 7% of the index. If we compare returns over the last 4 years, you can see the attraction of the global small cap index. The annualized return has been considerably more than UK small caps, and far more than the FTSE 250 and the FTSE 100, which have just returned a paltry 4% and 1% over the last 4 years. A good question is why small caps outperform, and nobody knows the answer. But this guy's opinion is definitely worth listening to. He's Elroy Dimpson, and he's Emeritus Professor of Finance at London Business School. He's also the co-author of a very widely read report which looks at stock performance over a very long period. And his comment here is that the small cap effect seems to have faded in recent decades. And if we were to look at this factor for the first time now, we'd only find a modest small cap premium. And in fact, the reward you do get for small caps may simply be due to the illiquidity risk you take by owning them. And he also warns against the higher management costs that you get when you have a small cap fund. That's the price of trading something which is illiquid. And this article from Vanguard in the US picks up on that thought. And it's a brief dialogue between Frank Chisholm, who's a senior product manager or marketer, and the head of the quantitative analysts, who's called Matthew Giannino. And you can think of a quant as a nerd, like me. When the product group asked the quantitative equity group about producing single-factor funds, they came up with a fairly standard list of factors such as value and momentum. But instead of saying small cap versus large cap, they said liquidity. And the justification that the quants gave was that many small cap fund managers are just harvesting that liquidity premium. And that's why instead of small cap versus large cap, Vanguard produces funds which target low liquidity stocks to harvest that liquidity premium. And in the diagram in the bottom right, they show the liquidity continuum from the largest and most liquid market on the planet, which is for US government debt, or T-bills. Then we go through public equities, and the sweet spot of liquidity which they point out is between public equities and a combined category of real estate and private equity. Vanguard have produced both a US liquidity factor fund and a UK liquidity factor fund. In the UK, you can buy the Vanguard Global Liquidity Factor Exchange Traded Fund, the ticker's VLIQ, and I've done a whole video about that. Vanguard ranks stocks within each regional group, combines the scores to form a composite, and then buys the least liquid stocks according to that score. And they rebalance that portfolio on a regular basis. And by doing that, they harvest this illiquidity premium. The reason why this is interesting is that it provides a cheaper way of getting exposure to the premium you're paid for owning small caps, because the ongoing charge for VLIQ is only 0.22% versus 0.35 or 0.38% for the global small cap index. So small caps are like an amplified version of the overall market. When times are good and there's a market rally, they tend to do better than the overall market. And if there's a crash, they tend to suffer more. So if you want them as part of your portfolio, you've got to be able to stomach that kind of up and down motion. Otherwise, you could end up getting burnt. Now, if you enjoyed that and you find our videos useful, and many of you tell us that you do find them useful, then please consider supporting us on Patreon. For just $5 a month, or preferably $10 a month, like Robert Bradbury, Adrian Green, and Ian Stenton, you could become part of our online community. And also, you get to take part in our live Q&A sessions and ask any question you like. And I'll probably come up with a plausible answer. So if you'd like to join us, it would be wonderful to see you on those regular Q&A sessions. And as always, thank you for listening.